Taiwan Semiconductor just posted the best quarter in company history, record profit, AI demand blowing past every estimate on the desk. And 40 minutes ago, chip stocks were still red. Good morning. It's Thursday, July 16th. I'm Nick Verducci with Eleanor Whitfield and Marcus Brooks. No fourth chair today, just the three of us. We've got a scoreboard to settle from yesterday, including one call that got erased almost as fast as it was made. We've got inflation data that lifted the big names and gutted the small ones, a $53 billion buyout, with Michael Burry publicly calling it an insult, an earnings split between an airline and a trucker that tells you more about the economy than either headline number, oil that still hasn't cooled off, and about 6 companies reporting before we're done with our coffee. Eleanor, Marcus, let's settle accounts first.
3 wins, 3 losses. Streak snapped +1.
3 and 5 now, streak -1.
Eleanor, yours first, because it's the cleaner story. You said ServiceNow, Salesforce, and Accenture all close red again yesterday, extending Tuesday's IBM sympathy sell-off.
And they did. ServiceNow closed down another 5.75%. Salesforce and Accenture both extended their Tuesday losses too. 2 straight sessions of software getting sold because of a hardware company's earnings call. That's the read-through trade playing out exactly the way it looked like it would.
No argument. That one was live the moment IBM said the word faltered.
Marcus, yours is the interesting one because you didn't just lose the call. The whole premise underneath it took a hit. SK Hynix closes higher again, above $200, you said.
It closed at 176.46, down 9%, gave back almost a third of Tuesday's 28% move in one session.
Read me your own words back from yesterday because I think you set this test up better than I could.
If SK Hynix gives back a big chunk of yesterday's move once the leveraged ETF rebalancing flow dies down, that's your case. Flow, not fundamentals, just delayed instead of avoided. Yeah, that's exactly what happened. I built the trap and then walked into it.
I'm not going to pretend that doesn't feel good to hear out loud, but I'll say the same thing back to you that you said to me last week. Winning the call doesn't end the argument. 19% give back doesn't prove the HBM demand story is fake. It proves Tuesday's specific 28% print was inflated by mechanics that had nothing to do with chip shipments.
Fine, fair. The supercycle thesis isn't dead because one leveraged ETF got its rebalancing flow. But I said it would hold above 200, and it's $40 past not holding. I lose that one clean, no lawyering.
Appreciate you not doing what you called Eleanor out for avoiding last week.
Wouldn't be fair otherwise.
All right, accounts settled, on to the actual tape. Eleanor, start us where the money moved yesterday.
Big tech had a very good day, and almost nothing else did. The S&P 500 closed at a record, 7572, up 0.38%. The Nasdaq closed at 26,269, up 0.62622. The Dow added 151 points. All 3 record or near-record closes, and it was almost entirely 4 stocks doing it.
Apple hit an all-time high, up around 4% on the day. Amazon, Microsoft, Alphabet all up roughly 3% apiece. That's the whole story of the index gain, right there. A handful of names on a rate cut trade after Tuesday's soft CPI and yesterday's soft PPI both.
And underneath that record close?
Underneath it, the semiconductor complex got hammered. Micron fell 8% on resurfacing China competition fears, and it dragged Intel, AMD, Lam Research, and Marvell down with it. The whole chip ETF, the SOXX, down about 4% on the day.
Which is the part that actually bothers me, because ASML, the equipment maker that basically gates how much AI chip capacity anyone can build, raised its full-year sales outlook and said it's expanding chip-making equipment production by 30% on AI demand. Genuinely bullish news, and the group sold off anyway.
So a strong report from the most important supplier in the chain couldn't buy the group a green day.
Correct, and that's not nothing. When good news from the picks and shovels player doesn't lift the miners, that tells you positioning matters more than fundamentals in the short run. Everyone's already long this trade, and Micron's specific competitive fear was enough to trigger de-risking across the whole basket regardless of what ASML said.
And I'll push back here, it's just dispersion. One name has a company-specific problem. The market temporarily treats the whole sector as one crowded trade because that's easier than doing the work stock by stock, and it sorts itself out in a session or two. Happens in every hot sector eventually.
Give me something concrete. What would make you concede Eleanor's version instead of yours?
If Nvidia, the actual bellwether, starts trading down on ASML-style good news too, not just Micron-specific news, for more than a couple sessions running, one name getting punished for China exposure is normal. The whole complex ignoring genuinely good supplier data repeatedly is not. We're not there yet.
We may be closer than you think. And hold that thought, actually, because it's basically today's story, too. Let's not solve it twice.
We'll get there. Healthcare was the other loser yesterday. Johnson & Johnson down almost 2%. Elevance down over 7% despite beating on revenue.
Which is its own small lesson. Elevance topped revenue estimates and still got sold hard because guidance and margin commentary told a worse story than the headline number. The market's pricing the next 2 quarters, not the one that just happened. Same thing we saw in bank earnings the day before.
And away from equities. Anything in the cross-asset picture worth flagging?
Gold slipped about 0.6% to just above 4,028, which is a little odd on a day oil's climbing. Usually those move together on inflation fear. My read is gold's trading the rate cut story, oil's trading the supply story, and yesterday the rate cut story won.
Bitcoin cooled off too, back near 62,000, giving back some of its earlier week gains as investors weighed the good inflation data against the oil-driven risk. Nothing dramatic, just a step back from a strong run.
Let's move to the story that actually moved a single stock more than almost anything else this month. PayPal.
Reuters reported Stripe and Advent International jointly offered $53 billion, $60.50 a share, a 28% premium to take PayPal private. Stock ripped up as much as 19-20% intraday. Roughly $50 billion of that offer is already committed bank financing, so this isn't a speculative approach. There's real money behind it.
And yet the stock traded well below the offer price all day.
Because the loudest voice in the room is fighting the price, not cheering it. Michael Burry, whose fund holds PayPal as one of its largest positions, came out and called $60.50 simply too low and put his own fair value range at 75 and, on the high end, into the 110 to 115 area.
Which is a genuinely wild spread, from a stock trading at 9 times earnings before this news broke to Burry saying it's worth double the buyout price. That's not a rounding disagreement. That's a totally different read on what this business is worth.
Who's more likely right in your gut, the private equity math or the value investor?
Honestly, somewhere in between, and that's exactly why the stock's trading in the high 50s instead of at 60.50 or at Burry's number. The market's pricing real deal risk, antitrust, a board that might hold out, headlines that leaked before signing, not disputing that PayPal's cheap.
I'd add the options angle to this, because it's the part regular listeners might miss. PayPal's options chain went from a normal liquid vol surface to something that trades almost like a merger R bond overnight. Dealers don't need to hedge a stock that the market now treats as capped near the deal price and floored by deal break risk. Meanwhile, the VIX barely moved, 16.2, down about 2%. That gap, violent single-name vol next to a completely calm index, is the tell that this is a dispersion story, not a fear story.
Plain version for someone who just hears PayPal up 20%.
The market thinks a deal happens, just maybe not at this exact price. And with Friday the largest options expiration of the month, watch for the vol pattern to shift again once this week's contracts roll off.
Did the rest of payments move on this at all?
Barely, and that's telling in its own way. Visa, MasterCard, American Express, the actual card network rails, traded essentially flat. This is a wallet and checkout story, not a network story, so it doesn't threaten the plumbing everyone else relies on.
Though I'd watch it as a sentiment marker for the rest of beaten-down fintech. A credible $53 billion bid for a large cap that's been down 27% this year might nudge other funds to take a second look at names in that same discount bin.
PayPal's board is expected to weigh in as soon as Monday, so this one's not over. All right, 30 seconds because I need it. I actually made coffee at home for the first time in about 2 weeks this morning.
How'd that go?
Forgot to put the pot under the machine. Coffee everywhere. My kitchen counter had a worse morning than Micron did yesterday.
That's a low bar you cleared in the wrong direction.
Back to the tape, the after hours prints, because these two tell completely different stories about the same economy, United and JB Hunt.
United beat $1.99 a share against $1.89 expected, revenue basically in line. Clean beat. Stock fell 2 to 4% after hours anyway.
Why does a beat sell off?
Fuel. Costs jumped 84% year over year to $2.3 billion, and management said elevated fuel prices could add nearly $6 billion to next year's cost base versus what they'd budgeted. Third quarter guidance of $250 to $350 landed well short of the $360 the street wanted.
Meanwhile, JB Hunt did the opposite. Blew past estimates, $191 a share against $171 expected, and the stock jumped about 9% after hours. Intermodal revenue up 22% year over year, loads up 10%, revenue per load up 11%, and their operating ratio improved almost 2 full points.
So freight demand is fine, but fuel is eating margins somewhere else in the same economy.
Exactly, and that split matters more than either number alone. JB Hunt says good side demand and pricing power are genuinely intact heading into the back half of the year. That's a real, healthy signal.
And United says energy costs are still the wild card for any consumer-facing margin-sensitive business, even with headline inflation cooling. Both are true at the same time. It's not contradictory, it's just two different exposures to the same oil story.
Which brings us to oil itself, because it hasn't gone anywhere. Where does it sit this morning?
Brent's still above 85, WTI near 80 after straight session higher after another round of U.S. strikes near the Strait of Hormuz overnight, and the naval blockade that's now been running for a full day.
And it's not just headline pressure anymore. This is a blockade with a fatality already attached to it from earlier this week. That raises the floor on how easily either side backs off without looking weak.
Devil's advocate for both of you. Is there a version where the market's actually underpricing this, not overpricing it? Brent at 85 with an active blockade, and a death already on the books feels almost calm.
It's a fair challenge. The VIX is still sitting in the mid-teens, which is a genuinely low fear print for a live conflict with confirmed casualties. I'd watch that gap closely. If oil pushes toward 90 without the VIX moving at all, that's complacency, not resolution.
I'd push back only slightly. There's reporting that sanctioned tankers are still finding ways through the strait, transponders off quietly. 6 of them slipped through in the past week alone, carrying something like 12 million barrels combined. If the oil is still moving even under a blockade, that caps how much further the price spike can realistically run. The market might be pricing that leak correctly.
That's fair, and it's consistent with Brent sitting in the mid-80s instead of triple digits. If the blockade were airtight, you'd expect a much bigger number than this.
So watch the tanker flow, not just the headlines. Noted. Let's do today because it's loaded, and this is where our unresolved argument from earlier actually gets its first test. Eleanor, what already happened before we even got in this morning?
Taiwan Semiconductor reported, and it's not close. GAAP earnings of $4.31 a share against roughly $3.87 expected, revenue of $40.2 billion against $39.6 expected, up almost 34% year over year. Gross margin 67.7%. High-performance computing, the AI bucket, is now 2/3 of total revenue.
That is about as clean a beat as you will ever see from a company this size. Margins expanding, AI demand not slowing down even a little.
And yet,
as of this morning, chip stocks are still red into the open. Nvidia down over 1% pre-market, AMD down more than 2%, Micron down another 2.5%, Broadcom down over 1%. The best quarter in TSMC's history, and the group can't catch a bid.
This is exactly the test I set up an hour ago, and I don't love saying that out loud right after losing a call, but pre-market reaction to an earnings beat that just landed overnight isn't the same as digested reaction by the close. TSM needs a few hours for the desk to actually work through the number.
give me the level, not the vibe for both of you. What do we look at by the closing bell to know who's right?
Whether Nvidia and AMD are still red or close to it by 4 p.m. If a beat this clean from the industry's most important supplier can't turn the group green by the close, that's not pre-market noise anymore. That's the market telling you positioning is maxed out and the fear trade in chips is bigger than any single earnings print can offset.
My side of it, if the SOXX is green by lunch, this was exactly what I said, an overnight reaction lag, nothing more, and that AI CapEx story is fully intact. I don't think this one's close, honestly. I think the number's too good.
Two people, same data, opposite conclusions, and I'm not picking a winner. That's today's split for the listener to watch. Overall futures are basically flat to slightly lower this morning, Dow off about 30 points, Nasdaq underperforming on that same chip weight.
And it's not just TSM today. United Health, GE Aerospace, Abbott, US Bancorp, and State Street all report before the bell, a genuinely stacked morning across healthcare, industrials, and banks.
Plus, retail sales at 8:30 forecast up 0.2% after last month's much stronger 0.9, and jobless claims same time. If retail sales comes in soft on top of everything else, that reopens the "is the consumer actually fine?" question that oil at these prices keeps raising.
Translate the retail sales number for someone who just hears a percentage.
Simply, are people still spending at the register even with gas and food costs elevated? A slowdown from 0.9 to 0.2 is already expected. That's not alarming on its own. It's a much softer print than that, paired with weak jobless claims that would actually move things.
There's also a Philly Fed manufacturing read this morning, and the Atlanta Fed updates its GDP Now tracker at 11:30 last read was 1.3% growth. Put those together with retail sales and you've basically got a full checkup on the consumer and the factory floor before lunch. And tonight after the close, Alcoa reports an early aluminum demand read, and Netflix has its marquee print of the week. Elevated options pricing on that one already.
So today's not a one-off Leica Netflix tonight, and this earnings stretch just keeps rolling into Friday's options expiration on top of it.
Right. This whole week has been that.
All right, closing calls. One specific and checkable thing each for today's close, Eleanor.
Nvidia closes red again today, even with TSMC's number behind it. If the best supplier beat in years can't flip the bellwether green by 4 o'clock, that's confirmation this is a positioning problem in chips, not a one-morning digestion lag.
Marcus, and I already know you're taking the other side of your own test.
I am. SOXX closes green today and Nvidia specifically closes up on the day. TSMC's number is too clean to sit unrewarded for a full session. By the close, the market catches up to the print.
Same data, same close, opposite calls. We'll have a real answer on this one by tonight, not a vibe. So here's today. Retail sales and jobless claims at 8:30. 5 more companies reporting before the bell on top of TSMC's number already out. Alcoa and Netflix tonight. And oil still sitting above 85 with a blockade that hasn't cooled off. Watch whether chips actually turn green by the close. Watch the retail sales print against an oil price that's still elevated. And watch for any board movement on the PayPal bid. Live takes on all of this throughout the day at Nova Ventures CE on XL. That's your Nova Ventures morning brief. Have a great Thursday, and we'll see you tomorrow.